Ticker symbol NTRA is well over 100% in the past year. And today we'll be taking a look at this soon-to-be profitable, high-growth machine, which is enjoying explosive growth through the use of royalties. Its gross profit has grown by over 109% in the past year, and adding to this, their revenue growth is accelerating, and they have had consecutive quarters with margin expansion. So today we'll be looking at none other than Natera, a healthcare company. In their annual report, they state that they're a company which focuses on diagnosis with proprietary molecular and bioinformatics technology that is being applied to change disease management. Now this of course is very broad, but what they aim to do is to make genetic testing be more mainstream. They want this to be the new standard of care in order to allow doctors and hospitals to inform earlier interventions that can allow patients to live longer and even healthier lives. They have basically developed these sort of tests which analyze the cell-free DNA, which is DNA that you can find in your blood, not inside any specific type of cell, and they also have algorithms and other technology to analyze the results from these tests, which can identify variations in the DNA of the different patients and detect a very wide range of conditions. Now they're mainly only focusing on women's health and oncology at the moment, but this allows them to detect conditions such as various types of cancer. They can even assess transplant rejection and estimate the probability of the organ being rejected after transplant, which can improve substantially the quality of these surgeries, and they can also detect chronic kidney disease way in advance. Now this is only the start, because this is what they're focusing on right now. But their technology works extremely well, it's being tested, and it's becoming more popular every single year that goes on. So imagine in a couple of years how much they will be able to tell only by doing a small genetic DNA test. Now all of this research cannot exist on the product being free, they have to make money somehow. And they have developed two different ways of making revenue from these tests. The first one, we can call it product revenues, which is basically when they sell the test kits to healthcare providers. Remember during the pandemic when you had to do a COVID test? Well, this is the same, but they do it for DNA. So it's generally a blood test that is used to collect samples from patients. But on the other hand, they also have processing revenues, where these tests are then sent back to Natera so they can analyze all these samples using their algorithms and their different technology and machines that is used in order to detect the different conditions and provide the results for these tests. Now when we look into their financial analysis, it's still not there. This company is a growth machine, but they're still not profitable yet, which is why we cannot calculate their return on capital employed, their interest coverage ratio, their cash conversion, or even their profit margin, because most of these variables are negative since they're all calculated either by their net profit or by their free cash flow generation, both of which were negative in the last quarter. However, we do have to say that they have a very solid gross margin above 55%, that when we look at their financials, we can see that they have been evolving at a very positive pace. The revenue growth accelerating in the previous quarters, as we have been able to see, with the revenue growth accelerating in the last few quarters since December 2023, and their gross margin and their net margin increasing at a very fast pace. We can see that their net margin in December 2023 was at a negative 50, and now it's at a negative 14%. It's on track to become profitable in 2025, because this great combination of revenue growth and margin expansion is exactly what we want to have in our quality businesses. However, I'm a bigger fan of investing in companies once they've become profitable and we can exactly see what kind of business they're operating. When we look at their efficiency ratios, since these usually follow net profit as well, we can see that they have been rising consistently, yet they're still in negative territory. However, give this company a couple of quarters or a couple of years, and I'm sure we will see these efficiency ratios skyrocket. Now, this is something that we can analyze despite the company not being profitable yet, because they are being very responsible with their balance sheet. They do have over twice the total assets than their total liabilities, which is able to give them a very solid current ratio. And as we can see in 2023, despite their assets actually increasing year over year, their total liabilities actually decreased, which is something very nice to see, and we can see that Natera's management is very conservative and they want to do the things right. Another thing that we can assess is their fundamental analysis. And this company currently gets a very solid 5 out of 8 ticks, which is very good, especially considering that they're not profitable yet. This company, as we have seen, has a very solid balance sheet, as they can cover all of their short-term liabilities only by using their current assets. And I'm happy to say that this company has been managing to grow their free cash flow generation. Of course, it's still not positive, but every single quarter this has been improving and they're getting closer to that very big milestone. And this is mainly allowed due to their organic revenue growth, which we have been able to see, and it's growing at a very fast pace and even growing faster than in previous quarters. And now the two most important things that we see in this slide are first of all pricing power, and second of all their existing moat or the competitive advantage, which I'm happy to say that Natera meets them both. Number one is pricing power. What I classify as pricing power is when a company is able to raise prices above inflation without losing many clients. And when I think of Natera and genetic and DNA testing, I believe that there are not many alternatives when it comes to these kind of procedures in the healthcare segment. And in my case, regardless of my situation, when it comes to healthcare, I want the best of the best. I want to ensure that whatever procedure I'm taking is as certain as can be. So I want to take the tests which have the best recommendations. So in my opinion, if I was a patient, taking one of these tests is not like a consumption buy. It's more of an investment on your healthcare, because it can rule out very severe conditions, but it can also inform you of different diseases before they actually get too bad to try to handle them. And on the second point, they do have an existing moat and a competitive advantage, and one of the purest forms of competitive advantage there is, which is through patents. Now this is extremely common, and it basically means that for that specific product with those qualities, no one else but you is allowed to deliver and produce that kind of product for the next 5, 10, or even 20 years. And in the case of Natera, they have a very extensive patent portfolio. However, we do have to consider that there are very big players in this segment as well. There are already some which have solutions in the market and some which have a greater accuracy than Natera's products. However, this is not true for the majority of the portfolio. So I do believe that their existing moat holds. However, there are a few points that I didn't like. Starting with, of course, the fact that they don't have a low liability risk. Despite having very low liabilities in comparison to their assets, since their net income is still negative, they cannot afford their interest payments. I do have to say that these interest payments are not very large, so once they start becoming profitable, this will be no issue for them. However, as of this quarter, since they're still in negative territory, I don't like that this company has this issue. Next is their cash flow consistency, which, although we discussed that their free cash flow is actually growing, and it is, it's all over the place. We have seen that their revenue and their net income is extremely consistent and they're improving quarter after quarter. However, it's very difficult to predict what their cash flow will be next quarter. And finally, we can move on to their dividends and their share buybacks, in which case they offer none of them, especially because it's an up-and-coming firm. They will probably start to be profitable this year. However, I would like it better if their shares outstanding actually stopped rising and stayed constant for the following quarters. Now moving on to their valuation analysis, as I mentioned previously, there is no way to do a price to earnings comparison for this company, as their earnings are actually negative. However, by using a website called AlphaSpread, you can get a historic calculation of the intrinsic value for this company using two different approaches. First one, the relative valuation, which is comparing all their ratios towards their competitors, and the second one, which is the discounted cash flow analysis, which I'm sure you're familiar with. Now according to this, currently this company is overvalued, which would make sense, especially since currently the 130% increase in stock price valuation can have actually distorted the price of this company over the reality of their business, especially because most people believe that they will become profitable this year. Additionally, since their free cash flow is negative, they currently have a free cash flow yield of negative 1.4%, which cannot be compared to the long-term inflation rate, as it means that you're basically losing money if you invest in it. But if you're interested in this company, I wouldn't recommend to guide your decision on the free cash flow yield at the moment. And now when we look at risk and possible challenges, I do believe that this company has very high inherent risk, especially when it comes to two different fields. The first one being the possible upcoming regulation changes. I've said this before, but when it comes to healthcare companies, with the new administration that is running, it has raised a lot of uncertainty. There have been hints and there could be a regulatory change at any moment, which could target the healthcare sector. Or there could be even more cost-cutting procedures, especially considering healthcare in the US. This, of course, would have a big impact on this company. However, it is something very unpredictable, so we can't tell for certain how bad that could be. And the second one is not meeting performance objectives. As I've stated previously, they have a lot of competitors in this field as it's a very attractive niche. However, they have to keep maintaining and investing in R&D in order to innovate, come up with better procedures, more accurate, and even expand the focus of these tests. Remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence However, I believe that this company has a strong competitive advantage, or is at least developing one, but it still needs to be able to generate consistent cash flows and improve its return on capital employed. So although I believe that this is a good company and could be a good investment due to especially its valuation, it is a high risk, high reward play. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.